Okay, thank you very much for joining the session. So I take over from Volker Wieland, chairing the session. Now we have a kind of switch of topic. It was already in some of the questions that we had in the morning on fiscal policy. So our session is on the second panel here is on fiscal effects on inflation and the inflationary effects of fiscal policy. So basically about monetary fiscal interactions, but really looking at the object that we are interested in mostly is inflation. So Volker already set up the ground rules, so we will proceed the same way in this session. We have the three presentations by Pierre Wunsch, Luisa Lambertini and Thiess Büttner. Pierre is governor of the National Bank of Belgium since 2019, but he started at the National Bank earlier than that, I think 2011. And you have also experience in the government, in the fiscal section there, so he knows both sides of the policy-making coin. Then Luisa Lambertini is professor at Ecole Polytechnique Fédérale de Lausanne. She's a professor of international finance and has also worked on monetary fiscal interactions, so just our topic. And Thiess Büttner from the University of Erlangen-Nürnberg, thank you, is professor there of public finance, has worked on several topics, taxation, but also on fiscal federalism, which is pretty relevant also for the constraints that the monetary union faces. So, yeah, the floor is yours, Pierre Wunsch, and we can start. Thank you.
Okay, I have no slides. And I'll try to keep it relatively short so that we have more time for the debate. So thank you first for the invitation. I'm pretty glad to be here, first time. So the question put to the panel is twofold: the fiscal effects of inflation and the inflationary effects of fiscal policy. And my short answer to both questions would be yes. Yes, when inflation is coming from terms of trade shock, high gas prices in this case, oil as well, but mainly gas, it does lead to more fiscal support and deficits. And second, yes, fiscal support is essentially inflationary. So I know that in some cases fiscal support took the form of price controls, and then you can have a debate on whether if it's, like in France, controlling energy prices, whether it's inflationary or not, maybe it's not. But I guess, there is a broad consensus on the fact that there were many measures. We have 500 lines in the work that was mentioned by the ECB. And mostly the measures were not very targeted. And I think that was to be expected to a large extent because it happens to be that not only the poorest people the last decile vote, so politicians always give to more people than we would like, and I think that's a fact of life. So the big picture, I think, remains that we have today monetary and fiscal policies going in opposite directions. So how bad is it? And before trying to give an answer, tentative answer to that question, I would like to take a step back and recap a little bit what we know, broad brush, about the interactions between fiscal and monetary. And of course, formally, the link between the two go through the intertemporal budget constraint, which to some extent also depend not only on deficits, but also on interest rates and prices, so real interest rates. And the question here is really twofold again. Who's going to take care of public finances, the budget constraint, and who is going to take care of the aggregate price level? And you have papers, many papers, for instance, by Lieper, about these monetary and fiscal dominance regimes where you can switch from one to the other under different circumstances. Now, if we go back to the heydays of the 50s, 60s, and 70s of Keynesian policies, there was actually no clear-cut separation between the two tasks. It was the days of the celebrated policy mix where basically central banks were not independent and they were contributing together with fiscal policy to both objectives. And what happened in this framework? Well, inflation. And then what happened after inflation? Paul Volcker came. Okay, that's very short, the very short summary of what happened, okay. But what is clear is that from the 80s and 90s, there was a growing consensus to go for a clear allocation of tasks between monetary and fiscal, based on reaction functions and a lot of arguments, and probably the failure of the policy mix regime. So we entered the era of monetary dominance, where central banks were dealing with the cycle, well, price stability, but we had the divine coincidence, so price stability and the cycle, and fiscal policies were to become passive. Now, the term passive is a bit misleading because it actually means that there is dominance of monetary policy and that fiscal has to react, for instance, to higher interest rates in reducing public expenditure, at least compatible, in conducting a policy which is compatible with the budget constraint. And sometimes also it means that fiscal would have to backstop the central banks if they make losses. And in Europe, of course, we had the fiscal rules of the treaty to make sure that monetary policy could operate away from fiscal dominance. But life is never that easy, is it? So before COVID, inflation was too low for too long, and there were ever more discussions on the fact that fiscal should come to the rescue of monetary policy to bring inflation back to 2%. I was never a fan of that because actually the economy was doing well, and I was not sure of, whether we should be more ambitious in terms of supporting the economy. But the fact of the matter is there were ever more papers on the need for fiscal to come to the rescue of monetary to go back to 2%. And then came COVID. And then the problem was that monetary policy in itself was ineffective. I mean, if people are stuck at home, you can reduce interest rates, but it's not going to have an impact on the economy unless through actually the fiscal plans that were put in place. So there was a lot of complementarity between fiscal and monetary in those days. And I think we did what we needed to do. And the efficiency of monetary policy during COVID went through fiscal support. And then inflation came back. We had a succession of supply shocks, and monetary policy moved away from the divine coincidence. We first tried to look through the shocks, and we looked through the shocks, and we saw ever more inflation. So we had to move from a very accommodative stance to normalizing, and then ultimately, it was mentioned by Christine Lagarde this morning, a tightening in just a few months. And yes, we found fiscal policy in the way with around 650 billion of supporting measures. And again, honestly, I think we should have expected that. It was a big shock, and confronted to a big shock, politicians, if they have room for maneuver, and even if they don't, they will do something about the shock, and more broad than we expect. We said always targeted and temporary, and it's never as targeted as temporary as we would like it to be. So now we are post-COVID, and the question is, where do we go from there? And the easy answer is that fiscal should go back to passive, i.e. consolidation mode, especially in high debt and high deficit countries. And this is indeed what the Commission, the communication of the Commission of March, has been recommending. No more escape clause and deficits having to go to below 3% in 26. So, what can go wrong? Well, will fiscal policy rebuild the buffers, the fiscal buffers that were used during the last crisis? Will it behave contra-cyclically instead of pro-cyclically? And honestly, the experience of the past 30 years is not very encouraging. According, but there is a lot of literature, for instance, to Atinasi and co-authors, there were not enough buffers built before the financial crisis, and some other papers point to the fact that in the 10 years before the COVID crisis, there were also too little buffers rebuilt, and that fiscal policy was quite pro-cyclical. So this points to a possible or asymmetry in the reaction function of fiscal policy. Supportive in crisis time, but also pro-cyclical during rebounds, with higher public debts as a result. And here I guess one should consider two cases. A mild case of fiscal policy being pro-cyclical, but still respecting the intertemporal budget constraint. And another case of more severe fiscal recklessness that, at least in some countries, could lead to unsustainable fiscal policies. So in the first case, fiscal consolidation takes place, but too slowly. And then fiscal policy goes against monetary tightening. Rates have to go up more than if fiscal would be countercyclical, implying higher debt burdens, and at the end of the day, more need for fiscal consolidation. This is probably a little bit the situation we are in today. But there is a second case where fiscal policy is not credible, or not credible enough. And again, possibly only in a number of countries. This can lead to a game of chicken, a la Sergeant Wallace, where fiscal authorities would hope to impose fiscal dominance and monetary authorities would try to keep control of inflation. And this is actually the situation that prevailed initially between Paul Volcker and the Reagan administration. So in 84, Volcker was asked to come to the White House and he was told bluntly, don't raise or don't hike before elections. So, of course, that is not possible in Europe, but just to make the case that this is not purely theoretical. But there is also a third case where fiscal authorities are perceived or risk being perceived as being non-credible. And the central bank then needs to offer a backstop in order to avoid multiple equilibria. And that's where OMT and TPI enter the game. And I've been very supportive of both. Well, TPI, I'm too young for OMT. And if this looks too theoretical, note that the recent UK experience was an interesting combination of a game of chicken and a temporary monetary backstop. So the Bank of England said, okay, we're going to do something for these pension funds, but you guys at the Treasury, it doesn't work, or Prime Minister, do something about it. And I'm glad to know that it is the Bank of England that won the game of chicken. Now, what can we conclude from all this? You know, when in the early days of Facebook, you had to mention your marital status or whatever. So it was like couple, it was like bachelor, and you had one which was it is complicated. I think we are in the it is complicated situation. So in theory, the theoretical separation between fiscal and monetary policy is clear, but in theory only. I think in most cases, there are no pure regimes of monetary or fiscal dominance. And we have indeed experienced situations where fiscal and monetary were complementary, where they needed one another. And again, I think what we did during COVID was necessary. I have no regret whatsoever in this regard. Again, as some people said, fiscal would have also been complementary with monetary when inflation was too low. I'm not a big fan of that, but we can come back to it in the question time. But there are also instances where fiscal and monetary become somewhat antagonistic, especially away from the divine coincidence. And that's the situation we are in today. So fiscal policy in Europe has been too pro-cyclical during upturns, and this is suboptimal. But I think there is a broader problem, and allow me maybe to be a bit more philosophical here. Fiscal policy regimes are not exogenous to monetary policy. Like it or not, and it was unwillingly, the low for too long of interest rates before the COVID crisis has contributed to create a culture of easy money in our societies. After saving the banks during the financial crisis, and the economy during COVID, people expect us to continue, to save the planet, whatever. And we have been receiving the members of the Governing Council like hundreds of mail asking us, demanding us to save the planet and to spend money on the green transition. And this in turn, as if they would need that, put pressure on politicians to keep supporting the economy. How many politicians have I not heard saying in the good old days of low inflation. As long as your interest rates are so low, we are not going to consolidate. And I'm talking about ministers of the budget, and we have many in Belgium. So the low for long in interest rates had created a culture of easy money where even ministers of budget would tell me, you know, we're not going to do anything. We don't have a budget constraint anymore. And people even started misquoting Olivier Blanchard to make their case. When a politician comes to you and, you know, cites Olivier Blanchard, it means you're in trouble. And again, it was misquoting it, but they knew what they were doing. So I believe that we should not over-internalize fiscal constraints. But we should also maybe, and it's really a question, start internalizing the impact of monetary policy on the mood of the day. Another way to put it, look at the impact of our policies over the cycle. Having yet a low for long policy has a long, durable impact on the way fiscal authorities behave. And I think at some point we need to ask ourselves whether we need to take that into account. I also believe that the existence of OMT and TPI, which again I fully support it, means that we are past a clear separation principle. If there would be a clear separation principle, we would not have TPI. And to the asymmetry resulting from the lower bound, and you know that in our strategic review we put a lot of emphasis on the effective lower bound. So we basically have a symmetric objective function, but an asymmetric reaction function, especially when you are close to the lower bound. I'm a bit tempted to oppose the risk coming from asymmetric fiscal policies. Not to mention the fact that inflation at 10% has historically been more frequent than inflation at -6%. So my point here is there is not only the asymmetry of the effective lower bound. You have potentially the asymmetry of the risk of fiscal dominance, the risk of financial dominance, and again, the fact that historically you had more upsides to inflation than downsides. So to conclude, the euro area has been flirting with some kind of weak form of fiscal dominance for many years now, actually for more than 10 years. And I said flirting, yeah, in weak form. And I believe it is time to go back to the treaty, to recreate the space that is required for monetary policy to operate independently. This is what the Commission is asking for. It just needs to be done. Thank you.
Thanks, Pierre, and thanks for being perfectly on time. We move on straight to Luisa. Thanks.
So thank you for inviting me to chat about the nexus between fiscal policy and inflation. It is a pleasure, as usual, to be here. Thank you. So I instead have pictures so that I can tie myself to data and try to stick with it. So why is the nexus between fiscal policy and inflation so exciting to be discussed at the ECB and its watchers? Well, because, you know, let me try to give you a background of where we are and how we got there. So the euro area was hit by two large shocks, the global financial crisis and then the euro area debt crisis, one after the other. And this already had resulted in an increase in the debt to GDP ratio of the euro area average, you know, of about 20-30 points, from 64 to about 97%. And then the euro area had embarked in some fiscal consolidation and things were going along better when in 2019, COVID came and hit the world. and the euro area as well. So what you can see is that what was the result is that debt to GDP ratios, which you can see in the pictures, increased by 16 percentage points for the euro area average between 2019 quarter 4 and 2021 quarter 1. But this number is about 29 for Greece. It is 28 for Portugal, and it is about 25 for Italy. So here I show some euro area countries chosen either because they are large or because they have an interesting fiscal position, let me put it this way. And it is 3 years tomorrow when the general escape clause that the previous speaker alluded to was actually activated, giving countries freedom to run deficits. So what drove this increase in debt to GDP? The numerator went up. Why? Everything related to expenditures related to COVID that the governments had to do, the pro-cyclical fiscal policy that were put into place, but also really a tanking of GDP at the denominator. So this was the situation in 2021-22. Now, things have changed since then. First of all, we are not stuck at home Zooming in our pajamas, which is a good thing, I guess. And as you can see, the euro area economic growth has recovered. What you can see in this picture here is the real GDP growth measured the annual GDP growth, and as you can see, went from minus 20%, it rebounded relatively quickly, which is good. Things reopened, things started going again. Now, the bad news, the other picture that you see on the left, which was clearly discussed a lot this morning, is that inflation also picked up. And as you can see, from negative inflation, we went up to 10, 12% rates, sort of different from different countries for a number of reasons. I will not get into this. Now, what has happened is that as the economies reopened, the countries, the euro area countries started adjusting, the fiscal adjustment. So what you can see on the right-hand side of this slide is the fiscal stance. The fiscal stance is measured as the change of the primary budget today relative to the primary budget, government budget, of a year ago, or 4 quarters before. So as you can see, the fiscal stance was negative, so large counter-cyclical policies during the COVID, and of course turned positive and more restrictive as the COVID pandemic stepped back. However, and let me go back, geopolitical events have taken place. So Russia's invasion of Ukraine and the increase in oil prices, of course, have brought a slowdown of economic growth. As you can see in the picture, Ireland apart, which seems to be a bit of a planet for itself, is starting to slow down. And of course, this is going to have an impact on inflation and on also on GDP growth and on fiscal policy. As you can see, the fiscal stance is now approaching zero again. So the euro area members are not tightening fiscal policies as they were doing right after the pandemic. So to let's go back to the nexus of inflation and fiscal policy. So what is the effects, the fiscal effects of inflation? So let me be very clear. Inflation is a bout of inflation, unanticipated inflation, is always a good thing from the fiscal policy point of view. Why? Inflation erodes the real value of outstanding debt. It is clear, right? So this morning, we were discussing the role of inflation in the US. Well, in 46 and 47, US had inflation of 13% and 11%, and this contributed to a 30% reduction in their post-war debt. So it's clear that a bout of inflation is going to help, especially if you have a fiscal position which has grown, a fiscal debt which has grown, and a bout of inflation helps. Why? Because you can also reduce debt without using the standard fiscal tools, which, as we know, tend to be contractionary. Cutting spending or raising taxes turns the economy down. So, but these are the good things. So a bout of inflation, as long as it is under control, helps temporarily to reduce debt. But there are negative effects of inflation on fiscal policy. And basically that inflation raises borrowing costs in the long run. And here I would like to show you exactly what I mean. As you can see on the left-hand side are long-term debts. These are the convergence criteria long-term rates. Have been really compressed until the first quarter of 2022, and they have started growing since. Now, one important measure in debt stability is the snowball effect, which is this measure of how debt to GDP will grow. And this basically the difference between the rate at which the debt grows relative to the rate of growth of the denominator, which is GDP. As you can see, higher inflation, which brings higher nominal interest rates, is turning the snowball effect positive now. So basically, the effect of inflation on fiscal policies has these two parts, the good temporary part and the bad long-term part, which is the raising of the borrowing cost. Here I have to say the ECB's action and the credibility of the ECB in bringing down inflationary expectations is going to be fundamental. It's going to be fundamental in making sure that these long-term rates don't stay high for too long. Because if they stay high for too long, of course, the fiscal consequences for the euro area members are very important. Now, are there inflationary effects of fiscal policy? Of course, fiscal policy has an impact on many things, including inflation. Now, is right now fiscal policy responsible for inflation? I would say that by far and large, the fiscal stance is positive, is not very strong. This is to say governments by far and large, if you look at the euro area, they are not expanding. Maybe in Austria they are sending checks, but in many other countries they are not. So fiscal policy is not by far and large the reason why there is this inflation. And actually this morning we heard really where the important part, the roots of inflation is really coming from. Now, the last question that I was asked to think about is the connection between the fiscal effects of inflation in a monetary union. Now, the monetary union is an interesting combination because we have one monetary policy, we have 22 fiscal policy, And we, unlike the US, there is no federal fiscal policy. So what is the situation right now? The spread on the 10-year government bonds are getting high. On the left-hand side, you can see that the difference between the German 10-year bonds and the Greek and Italian bonds is between 180 and 200 basis points. So this is quite, this is a large gap. And here I have to say that the PEPP, exactly, played really a fundamental role during the COVID crisis. Here I borrowed actually 2 pictures from a paper written at the ECB, which evaluates the policy. It's the first evaluation of the policy. As you can see, spreads during the pandemic have remained really compressed. And this is really a very important role that they played to keep borrowing costs down so fiscal policy could be countercyclical. Now, is it the time for now letting the PEPP go? Well, it has been stopped in March 2022, and as you can see, the spreads are starting. So it is a very complicated situation at the moment. As Pierre Wunsch said, life is complicated, but it is very important to also understand that at the moment, the economic conditions are not the one that we saw at the restarting post-pandemic. And so I think that being vigilant and being flexible in accompanying the process of fiscal consolidation is absolutely fundamental. Thank you.
Thanks, Luisa, and we move on straight to Thiess.
Yeah, thank you very much. It's a pleasure being here at the ECB and its Watchers Conference. Thanks for having me. The topic, inflationary effects of fiscal policy and so on, is a really huge topic, of course. And I will just focus on this part, on the inflationary effects of fiscal policy, and I focus even more only on the rules, on the role of the European fiscal rules in this setting, because it's important to understand in a way the framework within which the fiscal policy evolves. And I thought I would do it in 4 steps. First, I would like to emphasize something that we all know, but I think needs to be re-emphasized, the basic rationale behind the fiscal rules. Second, then, I would like to stress some parallels between the current crisis, still sort of COVID crisis going on, getting in an energy crisis. Anyway, let's just put it simple. Some comparison between the COVID crisis and the financial crisis. There are some parallels that are interesting. I'm not trying to say, of course, that the crises are similar. These are very different crises. But in terms of sort of the footprint on the budget and so on, there are an interesting comparison that allows us to see how the fiscal rules are actually implemented and whether fiscal rules are implemented differently. So just seeing sort of some shocks and seeing how the fiscal system responded to this. Afterwards, I can then provide some conclusions. So let me re-emphasize the role behind the European fiscal rules. So the potential conflict between fiscal and monetary policy was a key issue at the creation of the euro. I was a student at that time and followed quite closely this debate. It was clear from the outset that this topic would develop a particular tension in a monetary union of sovereign states, since maintaining price stability is in the interest of all, but this objective is then subject to a common pool problem if national governments pursue their own interest. And I think it's important that, therefore, even if governments are fully benevolent, an inflationary bias might emerge. So it's a bit different from the traditional debate about a debt bias because of political economy considerations. And to overcome what may be called the institutional birth defect of the euro, the member states instituted basically two types of things. One is economic coordination, and the other was they committed themselves to fiscal rules. The latter, the fiscal rules, were implemented in particular to facilitate the job of the central bank to keep inflation in check by preventing excessive deficits and high debt. Of course, we all know that the rules have been changed various times, many times. And since, however, 2007, the orientation is sort of on the structural balance, on the medium-term objective. And therefore, it is interesting to see then how the two shocks played out in this rule book. And of course, the rules that we have here are no longer rules that are stupid because being absolutely rigid, but these are rules that take into account the macroeconomic conditions. So that's really part of these fiscal rules. So let's compare then the two crises, and the COVID crisis in terms of the annual output shock was sort of comparable to the shock in financial crisis, at least if we take annual data. If we look into different frequencies, the picture looks different. A difference is that we had a much quicker return to normal economic conditions after the COVID crisis. And one difference is sort of the initial situation that when the COVID shock hit, the public debt GDP ratios in Europe were higher than before, about 20 percentage points for the euro area, than before the financial crisis. The public sector deficits that were encountered during the two crises were sort of similar in the magnitudes. Of course, and that's also important for those that are more interested in the causal effects of the fiscal policy, the intention and the rationale for the intervention here is of course different. So in COVID, the emphasis has been sort of on fiscal assistance, and in the financial crisis, stability of the banking system was an issue, but at the same time fiscal stimulus. So anyway, if we do, I mean, the graphs would just show this in a second, but it's sort of clear that you see this sharp downturn, 2009 for the European Union, quite comparable to what we had in 2020. For Germany here, the figures look a little bit different, but basically the same story. But you see also the quicker return to normal, the quicker recovery, the stronger recovery after COVID. The debt GDP ratio is clear that it's higher when the second crisis hit. Net lending here is also similar, as I said, sort of the deficit for the European Union reached some point of 6% after the financial crisis, and that's quite comparable to the COVID crisis. Even if we take into account the next generation EU, which is typically not encountered in those statistics, even if we take it into account, the picture is a bit different. But of course, we will see how all this evolves over the next years. Now, how did the fiscal rules, how did the fiscal governance work in these two circumstances? After the financial crisis, or when the financial crisis hit, the fiscal rules were still applied on a country-by-country basis. Okay, so 20 out of 27 countries actually had deficits exceeding the 3% threshold, and therefore were subject to excessive deficit procedures. And then the European Commission ruled saying that, look, this is a severe economic downturn. It's okay if you have these high deficits in the moment, and then you have to start consolidation immediately after the recovery. Actually, for Germany, the issue was in December 2009, the European Council made the decision that Germany should in the end, start consolidating in 2011. So quick return to consolidation. The COVID crisis has been managed in a very different way. First, and that has been mentioned before, the general escape clause was activated. The same reason, a severe economic downturn, but a severe economic downturn for the entire union, for the entire monetary union, for the entire Europe, right? And so all of the member states were sort of operating under these conditions. Then a second important difference is that temporary COVID measures were included in the structural deficit, which has some implications about how to interpret the structural improvements. The pre-crisis non-compliance issues, and there were issues like 2018, 2019, there was a battle between the European Commission and Italy, or there was sort of a tabula rasa approach, okay, now it's a different situation. And we have seen unconventional measures for providing relief and stimulus, SURE and Next Generation EU. Given the quick recovery and the strong recovery after COVID, consolidation should have started in 2022 if the same standards would have been applied as after the financial crisis, right? But the EU Commission suggested and actually made sure that the escape clause is activated until pre-crisis output was reached. This is a different interpretation of the rules. No longer when the recovery is going on, but when the pre-crisis level is reached. Then, in 2022, the European Commission used further discretion to keep the escape clause activated. Meanwhile, in 2022, the output level of 2019 was reached again. Then, however, the European Commission did a further move and actually linked the deactivation of the escape clause with its own proposal for new fiscal rules. So it said, okay, we are going to deactivate the clause sometime in the future, but we will combine this with a new set of rules. So let's first decide about the new set of rules. Once they're in place, we make sure that they are enforced. And more recently, even they suggested to base the current guidance for 2024 on the new rules, which are only proposed and which are not approved so far. So out of this situation, the escape clause was still activated in 2022 when inflation jumped up. So, and actually member states took the opportunity here and actually provide something that may be called inflation relief, which for me is disturbing because the idea that the government can use spending to keep inflation and additional spending to keep inflation in check is sort of contrary to conventional wisdom. So if we take this picture together, what we have is, my conclusion is that the whatever it takes attitude that the European Commission rushed into in March 2020 has compromised the fiscal rules, that a quick return to the rule-based fiscal policy would have reduced the inflationary pressure, the extent of which, it's something that the experts need to find out, how important that is in the end for the total inflation picture. What I really find disturbing is that, and it reminds me of this old saying, you should not swap horses when you cross streams. Actually, when most needed, the fiscal rules are now in limbo because of the deliberate decision of the European Commission to put their own proposal now into the debate. So I think it is therefore very difficult to make predictions. I think it is an important area where we see that fiscal policy makes the job of the central bank more difficult in current times, and it's actually counteracting the attempts by the European Central Bank to sort of keep inflation in check. I mean, there are further things that we have learned, and I think to some extent it's a concern. So politicians might have learned that the crisis mode really is a way to get additional resources, to get more leeway. And I hope this is not the case. I mean, it's not so clear. As an economist, I'm always in the tendency to strain incentive effects too much, but I'm a bit worried, that after having seen so many crises, let's see here, the pandemic, the energy crisis, the Ukraine crisis, that the politicians, will learn that all those rules can be surpassed, even if we have no rules, can be surpassed by having a new crisis. And at least in Germany, there is a large audience, a large public debate about the climate crisis. That could be sort of the next candidate to sort of deactivate on the rules and have more fiscal leeway. So thank you, and I'm looking forward to any discussion. Thanks.
Yeah, thank you very much, Thiess. I think we can move now to the lead questions, and let them all ask together, and then the panel will answer them. The first question is by Silvia Ardagna from Barclays. Who needs a microphone? Can you? Thanks.
Hi, thank you very much for these very interesting presentations and for the invitation here. My question goes to whether we want to put a bit more emphasis not just on to consolidate or not, of how to do it. And there was a very recent ECB working paper, which I found it was very excellent, in saying that inflation is mainly affected when you raise public wages and when you ease VAT. So perhaps whether you can tell, whether we can strategize and think not just about public investment and the role that it has in the new fiscal rules, in the new fiscal framework, but also whether we can convince politicians to perhaps adjust in the right way. Thanks.
Thank you very much. Johanna Hietalahti from Municipal Guarantee Board.
That's correct. Thank you. I would like to go back to the turbulence in the banking sector and the issue that also Michael Bodo mentioned in his presentation earlier. The fact that Europe, we don't have complete banking union and no deposit insurance scheme. The US has contained the crisis through the cooperation of Fed and Treasury and the special deposit insurance scheme, which has now been extended to cover all deposits for the biggest banks, which, however, in fact means giving an implicit guarantee to all. This leads up to my first question. Do we have sufficient instruments in place in Europe at the moment? The banking sector seems to think that also Europe should have a single, well-funded deposit insurance scheme with virtually unrestricted access to public funds. So how realistic is this view, and should we have one? The second issue arises from the level of interest rates, which have risen because of the actions of the central bank. While rising interest rates causes such a thing that my friend calls a maturity mismatch crisis and duration crisis, can ECB keep rising interest rates if the effect is like this? Thank you.
Thank you very much. And now Gertjan Vlieghe from Element Capital.
Thank you. I want to pick up on two things that Pierre Wunsch said. One of them was that lots of people got used to this very low interest rate environment for a long time, and that caused changes in behavior, governments and other institutions, and no doubt that's true. And governments as well as banks are needing to learn that we're not in a zero rate environment anymore. But I would also like to pick up on something else. He made a Facebook reference. I'm going to make a Facebook reference too. An early slogan of Facebook was "Move fast and break things." And I just wanted to make sure that we're all agreed that moving fast and breaking things is not a good idea, because if central banks move fast, they will end up breaking things, and they will in fact not achieve the inflation target that they're supposed to achieve. But as Michael Bordeaux suggested, the breaking part will cause a crisis that will in fact cause them to undershoot the inflation target. Thank you.
Okay, thank you very much. I think we can give the panelists the word one by one. Thanks.
Oops. Is it working? Yeah, okay. Maybe I'll start with the last question. So move fast and break things. That would be a very, very bad one for a central bank. So, I mean, Christine Lagarde, I think, has been very clear that we have a sort of separation principle, which holds under most circumstances. Having been through the financial crisis in 2008, but I was then chief of staff, at some point, of course, you need to pay attention, but we are very, very far from that. But I don't think there is any intention of anybody among the governing council members to break anything. And I think also Christine and Philippe have been very clear on that. We need to see what is going to be the impact of what's taking place now in the financial markets. And this is going to be part of the equation of what we do or not do. But the first thing we need to look is transmission. Whether banks are going to react to, and it might just be a blip or something else, we'll see. Maturity mismatch crisis, I think the question was a bit the same. Is it going to have an impact on our interest rates policy? Again, as much as possible, we should rely on other instruments to deal with financial stability concerns. And as again Philippe said, liquidity to banks in Europe, which is banking based more than monetary policy, and liquidity provision to banks goes into more cracks, and to come to Jeremy Stein, famous quote, maybe than in the US. I would not exclude anything, even conceptually. I think at some point, if we would move to something which is really bad, we might have financial dominance for at least for a while. But we've been torturing the data in all directions, and honestly, what we see is no problem. I mean, you know, we've looked, and sorry, Belgium is not that important in Europe, but I have more information on Belgian banks. Even if banks would have to sell all of their obligations and take the losses, they would still have enough capital. So we are in a very different situation than what we've seen in some other places. The question on the instruments we have in Europe, you know, Silicon Valley Bank was not about insured deposits. So even if you would have a European EDIS, it wouldn't have made any difference, because it really was about the non-insured deposits. Now, I know the Commission wants to change the seniority of deposit. I think it's a very good idea. We've been fighting a little bit at the resolution board. I was a member at some point, with this idea that in Europe there is less MREL requirement for small banks than for big banks. I'm not saying this is a big issue, but that's where you start having discussions about what is protected, what's the level of protection, are there differences between small and big banks? And I think we've made a mistake there in not making it sure that we have the same treatment and protection in big and small banks. It has changed to some extent because we have introduced the fishing option, which is basically allowing some countries to say, you know, I consider these and those banks as, you know, quasi-systemic, and to allow for more banks to have the 8% MREL. I mean, those are things we will have to come back to. I don't think it's a big issue today. But I think it would be wrong. I don't know, each time there is a crisis in Europe, people come back with the banking union and say we need to complete the banking union. But it's really, in this case, not an issue of insured deposit. I haven't seen anybody saying, oh, I would rather be in Germany than in any other countries because of the quality of the deposit insurance. It's not about that. Quality of public expenditures, yes, but, you know, at the end of the day, politicians do what they feel they need to get elected. I don't have a lot of, you know, I'm not very optimistic in terms of being able to influence the way they conduct fiscal policy at this level of granularity. Stop there.
Thanks a lot.
Well, let me try to bring back the discussion on fiscal policy. I'll start actually with Silvia, who has worked a lot on this herself, on how consolidation should be done. I think this is a very important part of the story. We know that spending and taxes have different effects on economic activity, and the cost of a fiscal consolidation is different depending on how you do it. Now, the issue is how to put the incentives on the floor so that politicians find the right reason to do it. And I guess this is where academics have to take the responsibility of bringing the message out and making convincing studies and try to let this knowledge percolate. Raising taxes by far and large tends to be the worst way to consolidate relative to other ways. So I agree it is a very important point. We should consolidate and we should try to consolidate in the right way. So let's try to bring what we know out. Now, I will go back to the question of, move fast, break things. I really applaud what the ECB did, that in the middle of the pandemic, they started PPP, no question. 97% of PPP was on government bonds, and this helped the situation go through. I totally agree that we need to continue looking at whether the transmission works, and there has to be this awareness that you need to be alert, and you may have to be flexible depending on how things going. Now, can the ECB keep on raising rates? I guess so. That's what it has to do, but it has to continue looking at what the situation is. And you have to be alert, and you have to be flexible. Being dogmatic, I think, never helped. Not breaking things.
Thanks a lot. Thiess?
Okay, I can't comment on too many questions, but on the consolidation issue, had the European Commission ruled that 2020 would be the year to return to the standard fiscal rules, which is for most European countries a medium-term objective of 0.5% for the structural balance. And okay, there are some problems with some countries, program countries, because of excessive deficit procedures. But anyway, so if the European Commission had invoked or deactivated the clause and sort of requested member states to return to usual in 23, I don't think it would be a major problem at that time, because the big deficits that came under COVID were temporary measures, sort of by definition. I mean, we all learned now what a pandemic means and what type of assistance can be paid out. But take examples like short-term work or assistance to people that have closed shops. Once the shops open, the reason for spending the money is over. And so you have an automatic improvement of the fiscal balance. And since the European Commission changed the rules to determine the structural deficit, that is saying that let's take the temporary measures aboard, this type of automatic consolidation was an easy way out. Of course, now the longer the period, lasts until we start consolidation, the more difficult it might be to do this, because additional demands have come up and so on, right? So there is, I would think that for political reasons, that in these budgets there is over time a tendency that it gets more difficult to actually do the consolidation job. So I think that's something that that is still possible. And I guess this, I think it's still possible because many of the measures that have been taken out of the leeway that was a side effect of all the crisis are also temporary measures that can be just stopped. I guess the more difficult part is the consolidation requirement that comes from higher interest expenditures. So the swing there is actually quite large and to some extent unexpected. But this differs from country to country. It's a question how all this is booked and how this is accounted for. But generally the swing is quite substantial, and so I guess that's sort of the new part that makes it even more difficult now to do the consolidation, than to do it in this environment with higher interest rates. There I think, of course, these are reasons why, to begin with, you want to have fiscal rules that make sure that debt-GDP ratios are not too high, right? And of course, once this is the case, you are in a more difficult ground. That's certainly the case. And then other issues like, I think deposit insurance is an interesting concept, and I was following the suggestions with interest that the European Commission put forward. I was always thinking that we need a smart institution like a reinsurance mechanism that sort of makes sure that everyone is part of this, but the difficult climate in Europe to discuss those issues sort of made it impossible to move this project further. But my perception is that this is, despite the turmoil in the banking sector, at the moment not a really the most pressing issue. But okay, that's for the experts. Thanks.
Okay, thank you very much. I think we can move on to questions from the floor. I saw one question here, but I was asked by Volker to look left as well. So I take the first. So first question I saw earlier, so maybe I start with your question and then I move on to the right side and track record then.
Thank you very much. We almost felt discriminated, but it's good now, thank you. Just on the fiscal stance, I was wondering whether I could probe the panelists a little bit more, because I wasn't entirely sure what their view was on the current fiscal stance. I guess Thiess was pretty clear that he thought there was still too much fiscal stimulus. The two others, I wasn't entirely sure. I mean, the ECB monetary policy statement in recent decisions has become fairly, I don't want to say aggressive, but clearly the language has been kind of upped a bit in terms of urging fiscal policy to maybe be a bit more supportive. And I think there's a bit of confusion among maybe markets people or ECB watchers whether maybe that fiscal stance is now being seen as improving, or is it still kind of counterproductive to what the ECB is trying to do? Thank you.
Okay. Thank you. Maybe I take 2 or 3 more questions from this side. So Daniel Gross, I saw 2 more hands, Ulrike and you. So maybe we can take these 3 questions as well. Thanks.
Yes, thank you. I wanted to come back to the issue of monetary fiscal interactions and the way they interact via the balance sheet of the euro system. As we all know, over the last years with the PSPP and the PEP, the euro system has accumulated over 4,000 billion euros worth of government bonds, and this was done to stimulate the economy when interest rates were at the lower bound and inflation was not close enough to the target of 2%. And I think it's also clear that the stock, which is still there, continues to have an expansionary effect. There's lots of ECB research itself which says that the existing stock keeps long-term interest rates about 160 basis points or so lower. So that means at present, the ECB has one foot still on the accelerator by keeping all these bonds and one foot on the brake by increasing short-term rates, which for me means that it's really about time to think about reducing the existing stock of bonds which the ECB still holds. And there, of course, the question is that these bonds yield zero. And in a sense, the ECB is in a similar situation as the Silicon Valley Bank, because you have to refinance it now with short-term deposits at an interest rate which the ECB itself determines, but still, given inflation, it's much higher than the 0, 3% and going up. But, of course, selling the stock would crystallize losses. Right? There's no problem with central banks having losses. Negative equity for central bank is not an issue. But still the question arises whether the fact that selling any of the bonds, that would crystallize losses, whether that has an impact on monetary policy decision. And I'm asking that to a member from the president of a national central bank, because all these bonds were bought under no risk sharing, so it goes directly then into the balance sheets of the national central banks. So the question is, does this fiscal impact of reversing QE, does it have any consequences for your decision making?
Thank you. Ulrike?
So thank you very much. I do have a question to Pierre Wunsch, because I thought it was very interesting that you said that you have the sound Belgian banking sector now, and even if they have to sell, if I got it correctly, all their bonds, it's no problem for them. And I was wondering a little bit, when there was this bank, the Silicon Valley Bank, if the bank got into trouble, and the financial markets reacted very nervously, and share prices dropped even of the banking sector in Germany, for example. And then I had a look on the webpage of the ECB or of the Deutsche Bundesbank, and there wasn't any statement for a couple of days, and I was wondering whether this is a good communication when financial markets are so in trouble that there is no comment or statement by the central banks. And perhaps it was different in Belgium, I don't know.
Okay. Thanks, Marie. I had one more question. Yes, please. Yeah. So can you move it up?
Thank you very much. I have a question, very practical question for Luisa Lambertini. Because you said inflation has a short-term una tantum effect, positive effect on the debt to GDP ratio. But it can have a persistent negative effect on the snowballing effect. So if you can have a jump in the price level without a persistent rate of inflation, you are in the best possible world, in particular, I would say, for heavily indebted countries. So the translation that I make of your statement is that Italy should be much more forceful in fighting inflation than Germany, just because it has such a higher debt to GDP ratio and wants to enjoy the loss of real value of the debt, but not incur in the persistent cost of higher rates of interest.
Thank you very much. So we can open the floor for the answers, the panel. Pierre?
Okay. You hear me? Okay. On the fiscal stance, in our projection, I think from 24 on, it's more or less okay. But I think first there is uncertainty whether countries are going to comply with the end of the escape clause and so on. And we should distinguish between the average, which is important for the stance, and the fact that a number of countries, and Belgium is one of them, are faced with fiscal positions that are not sustainable going forward and really need to make some efforts. And that is more important for possible fiscal dominance or financial stability issues. So I think the average is good, but you also need to look at some specific situation of some countries. But I mean, my answer is really, I mean, now the fiscal stance has to turn into consolidation on that front as well. Daniel, yeah, on QT, well, you know the accounting treatment is holding to maturity, so the idea was that we would hold the bonds to maturity. So we have some flexibility in terms of reinvestment, and we could stop reinvestments at some point if we feel it's the right thing to do. Having two instruments potentially going into different directions, I don't think it's really necessarily an issue. What you need to look is the net impact of what you do on the stance. And you may decide to do more with one instrument or more with another. But the fact that you know, we are engaging into QT, and then we can decide to put more emphasis on one or the other instrument, I don't see that really as a big problem. So why didn't we communicate when share prices were going down? I mean, part of it is it ECB or SSM, but I think that's not really the issue. I think we have communicated that, and many people have communicated our banking system is strong at European level, but also in each and every country. So the problem, I think, is more fundamentally how do you deal with issues of trust and contagion? Because, you know, markets are calm and suddenly you have one bad news somewhere and the temptation of the public is to say, haha, they've been hiding stuff. And it's very difficult to find a counterfactual to someone telling you, you've been hiding stuff. You say, no, I haven't. Yes, you have. No, I haven't. You know, it's not an easy game. And I'm always very, very cautious when I say, I don't, you know, the banking sector in Europe is very strong, and in Belgium I talk more about Belgian banks because, of course, that's what I'm being asked. But I'll always add, I would not exclude that there is a problem with one bank or one financial institution somewhere. Because if you don't say that, and there is a problem with one small institution somewhere, they are like, ha-ha, they lied again. So not easy, and I think we need to be relatively candid. I mean, there are many banks and financial institutions. We've been hiking fast. The likelihood that it's going, you know, that someone made a mistake somewhere is actually quite high, which in it by itself is not a problem if you believe that the system is strong. But of course, if it turns into a problem of lack of confidence and mistrust, you know, even a strong bank could be, I mean, Credit Suisse, in a way, was a relatively strong bank. If you looked at the numbers, history will tell whether, you know, this was just a run on the bank, a classical one, or whether Credit Suisse really had a big problem deeply somewhere that we didn't know. And of course, the fact that they had to communicate that there were some problems with reporting was leading to some lack of confidence in the bank.
So, regarding the question on the fiscal stance, is the fiscal stance too expansionary still? I show the data, right? Right now, the fiscal stance seems to be stationary. If we call fiscal seems to be neutral. If we interpret it as an improvement in the primary deficit or surplus. So right now, it's just on average pretty flat. Now, it's true there are still some countries with primary deficit, most of them, a few with primary surpluses, but the way I really interpret it is that I don't see fiscal policy as being, right now, the reason behind inflation, and any movement of the fiscal stance in positive territory would imply basically consolidation. And, you know, should be done at some point, but this is my interpretation. Now, to the question of what should Italy do, be happy about an increase in inflation at the moment versus the effect on long-term interest rates. I had a slide which I didn't show with my DSG model where I show what happened when there is a debt shock and inflation goes up and everything looks good. So, of course, this is well known among economists. Italy, however, has to, the effect on long-term rates is really the worrying part, because how affected any country with a large debt has to worry about the long-run effect of inflation and for how long interest rates are going to be high. But it's true, if you have a bout of inflation, countries with the largest outstanding debt, are going to be the ones that are going to gain the most. I would agree with the answer that Pierre did. Should the ECB start selling its bonds that has bought? I mean, this would certainly put pressure on the market, change prices, yields, fine. I think it's up to them to see what is the monetary transmission and how this is affected by their policies. And I think that conventional monetary policy and less conventional monetary policy don't need to move necessarily in tandem.
Would you like?
Just a few points, just to clarify, and I think it was clear from Luisa's comments also that it's not so clear how you define what is whether the fiscal stance, whether you have consolidation or not. I mean, already the net lending is the first derivative of debt, and we are dealing here with the second derivative. So do we think that the government is already on the path towards consolidation if it has a large deficit and if this deficit is decreasing? And I think it depends a bit on the economic circumstances. There might be economic, so if you think of a traditional business cycle, that might be the reasonable way to look at it. You don't want to, full go into the break, speaking in this loose way, and rather sort of there are automatic stabilizers in the background that you want to allow to work. But actually, if you're already operating at capacity, I think fiscal policy, which still runs in an inflation environment deficit, is expansionary. And the uncertainty there is large. It's partly because of extra budgeting. In a way, already the next generation EU is an extra budget. So in a way, how it works is you put a fiscal rule. You force the government to pass a bill through the parliament that sort of obeys the rule, but sort of you can at the same time have an extra budget. The next generation EU is a gigantic extra budget. And so all these extra budgets are there, and it makes it very difficult to make a prediction how those funds are used. So if the European Commission would, be speed up the next generation EU, we would see even widening deficits sort of in the next year compared to now. And the magnitude of the fiscal space that the German government had at the end of last year was about 400 billion euro. In terms of debt capacity outside of the so-called debt break. So you have those things, a lot of uncertainty what governments are doing with all the leeway they have created. I'm not sure, it's difficult to get a picture for whole Europe, but I guess that makes the predictions at the moment quite difficult.
Okay, thank you very much. Technically we have 4 more minutes, but maybe it's hard to collect a lot of questions. But I have one question. In all these considerations of interest rates and inflation, do you also look at the maturity structure? Because a country that has long-running debt will have a lot of time to enjoy high inflation, and the new debt will only be revalued in small fractions, whereas a country with short maturity won't. Do you distinguish countries on that dimension, Pierre or Luisa?
Well, this of course puts a very interesting, an extra analysis of what is the average maturity of the debt, and it is going. If you look at the average maturity, of course, you're going to see which are the countries which may be more sensitive to changes in inflation right now, and therefore they are exposed to changes in the nominal rates, for example.
Maybe just to add something, and it has been mentioned many times by the economists and others, but of course we've swapped 28%, I guess, or 30% of the debt to short term. Mm-hmm. And part of the losses on that will not be visible in the deficit because we'll just lose our reserves and more. In our case, we expect to lose more than our reserves, so go to negative capital in Belgium. I think a distinction that is very important as well in terms of, it's not really fiscal, but it's important is whether countries have mortgages with variable or fixed rates. It has a very different impact on the transmission of monetary policy, and it can lead to quasi-fiscal impacts in the sense that fiscal authorities would feel the need to compensate some people faced with big increases, for instance, in terms of mortgage repayments. But conversely, of course, if it's variable, the risk of higher rates for banks in Spain is much lower than in countries where you have fixed mortgages and where you have to look much more at whether the interest rate position was hedged, which I think in Europe it was because of the many stress tests that were made on interest rate risk.
Okay, thank you very much. Thanks for the questions, thanks for the answers, and I think I can conclude the session now.